Today, I thought a little blood, sweat, and tears. Boy, is there anything more descriptive, right? The title of today's session is, of course, Fed rides the painted pony on rates as the inflation wheel spins. Can they find the directing sign down on the straight and narrow highway? Man, I'm not sure they can. So I feel like, this song is very apropos at describing current market conditions right now. And of course, the Fed is boxed in the corner. Now, with all that said, market is rallying today, which there was some kind of indications of that earlier with some bullish option activity. Plus, as we'll look at, the activity on Monday was very, very bearish. So makes sense we might get a little rally. So we'll kind of preview or do a post-mortem on what the Fed said today and how it kind of ties in with that spinning wheel. But anyway, let's get rolling. So the ES right now is about 2%. Now, when we put things in perspective, let's go back to Monday, and I'm going to look at a ratio of declining issues plus advancing issues. And when you look at Monday, we're not going to focus on the composite graph there. We're looking at this yellow line. You'll notice 18. Well, if I change that out to a 5-day, 5-minute, what you're going to notice is that we had a huge spike up here, 32.5. What does that mean? There were 32.5 more declining stocks than advancing stocks on Monday. That's huge. Now, if we flip it around, we look at volume, $DVol plus $UVol. We're at one point, we're at over 140. Look over in the left axis over here. What does that mean? Over 140 times more volume on declining issues than advancing issues. When you see both of these metrics close to 10 or over, generally speaking, you're talking about a pretty significant kind of capitulation day, and that's exactly what we had on Monday. Now, as we're set up yesterday and coming into today, the Fed was expected to raise rates by 75 basis points. All that changed on Monday with the selling, again, sparked by last week's kind of leaked information on the inflation print. We get the CPI on Friday, and then boom, on Monday, we come to the harsh realization the Fed is raising 75 basis points, which Powell not too long ago said it was not going to happen. The fact of the matter is they cannot find the sign to the straight and narrow highway. There isn't one. It's called the Fed pickle. It's called the Fed conundrum. There's no way back except through significant pain, and nobody wants to go through it. Now, that doesn't mean we're not going to experience pain. It's a matter of we're not going to reorder the deck here, right? We're just going to reshuffle the deck chairs and try to make it look pretty as the Titanic is truly sinking. All right, so as we look at the ES, now let's focus on the VIX. Now, as we look at the VIX kind of reached an area of resistance. One thing I look at is, if we're above the Keltner channel. So, for example, on Monday, just to kind of profile how overextended we were to the downside and how high the VIX was. We closed outside of this 20-day exponential 2 ATR Keltner channel. When this happens, normally you're kind of nearing a low in the market. When I say low, I'm talking maybe for a week or two. Because the fact of the matter is, we're in a bear market. And if you look at what the Fed actually said, it wasn't really bullish, right? They're reaffirming the fact they're going to raise rates 75 basis points and 50. There was a chance for a pause in September. That's gone potentially. They're currently reducing the size of their balance sheet. I did a video a couple weeks ago on Fed on the QT, quantitative tightening, $47.5 billion. That's going to raise to $95 billion in September. They're expecting inflation to hit 5% in 2022. And if there's one thing we know about the Fed, they underachieve in terms of their projections for inflation as of late. And then they're looking for it to suddenly fall rapidly going into next year. But what they're targeting and they're committed to, and a little bit of a change in their statement today, is 2% inflation. Who in the world wants 2% inflation? Nobody. Especially if you're a working class person. Nobody wants to see prices double every 36 years. But the Fed does, and certainly the federal government is in full support of that inflation target done by the Fed. Obviously, they're feeling the heat right now, and they've stepped up their rhetoric in their statement saying they're strongly committed to bringing down inflation. Now, there was a standout. Kansas City Fed President Esther George dissented and only wanted 50. Now, as we look at this reshaping of the expectations on the part of the Federal Reserve, and it is shifting just from yesterday to today. So we look at July's meeting, 67% currently. Well, now we're at 1.5 to 1 3/4. 2.25 to 2.5 is only a 50 basis point increase. You're seeing all of a sudden, are we only going to raise a quarter? And that's a big change from yesterday, right? It was 89.5. Now it's down to 67. Now, again, might have been a little too harsh. 90% probability of 75 basis points next meeting. Again, nobody has any clue, right? There is no directing sign to the straight and narrow, right? There is no pathway to the easy Goldilocks scenario, right? Porridge is just right. I just don't think there's a way forward for it. I think we're increasingly becoming aware of that fact. As we look at September now, right, 2.75 to 3%. Again, we're seeing expectations diminish just a little bit on the higher side. And one of the reasons for that may be the fact that, the Fed did acknowledge that the economy is stumbling a little bit, right? I mean, Powell's telling the millennials, hey, just wait till you get older to buy a house. Like that. I mean, again, rates right now are going up. Borrowing costs are rising. And as you look at some of the stocks, in my at the close session last week, we talked about the negative expectation in ITB, for example. Home builders, man, watch out. If the Fed funds rate goes to 4%, what are borrowing costs going to be? All these homes they're building. How do you get financing for them? Mortgage bonds, NLY, they've been under pressure. Consumer finance companies like Discover Financial Service, huge down move here. Now, again, what goes down must come up, right? Just like what goes up must come down. And we get these little bounces in the market. Oftentimes they're led by short covering rallies. When you look over here in terms of the sectors that are outperforming today, cyclicals, they've had a terrible year so far, right? XLY, at support. These are some of the most volatile stocks in the market and also areas that have high short interest. So it's no wonder we're seeing the biggest boost today in cyclicals. And also look at technology, another one, right? Real estate hit hard, catching a little bit of a short covering bid today. And communications. There was some bullish activity today in Meta going out to January 2024 at 400. Man, is that pie in the sky stuff. The point here is with the market is that, look, and I did this little preview before we started today. There's a good chance we kind of rally off the Fed today. But don't get sucked into the realities of the saying this is the end of the down move. We are in a bear market. So again, we get the rally and then we look to get sold. And as we look at high short interest names, I got a little list over here, over 5% of the float. You notice here SRNE, right? Roblox, Pinterest. These companies that have done really poorly. Sabre, if you like, kind of your get out there entertainment space, Sabre here, right? EDU is a Chinese stock. One I've been kind of focused on for the last few weeks. Look at Chinese companies. Well, again, they're continuing to move. Plug, right? We're talking about, gas prices are high. Get out there and buy an EV, right? $60,000 and you got to finance it. What are you going to do? Right? So you got these companies over here that do have high short interest, and there is kind of a convergence of Chinese companies and high short interest that have done well over the course of the sell-off, this volatility over the past week. Now, as we look at what the Fed said, and we look at the reaction of bonds today, for example, we saw a big sell-off with the leaking of the inflation data, and then all of a sudden the inflation hits on Friday, and we started to see on Friday, inflation print hits. We see the sell-off on Monday as we start to see expectations of the Fed raising further, and we saw further selling yesterday, and then today we're seeing a little bit of buying on Treasuries. This is predominantly the selling here as a result of shifting sands of Fed expectations. It's not about inflation, right? Right now, for example, TYX, that's your 30-year bond minus TNX. If we look at the difference here at 0.18, We were negative, which we had an inverted yield curve. We've shifted slightly positive today. But look at the trend. As inflation's been roiling here, getting out of control, the spread between the 10 and 30 year has been coming down. So they're basically at the same level. You could look at every part of the yield curve, the exception of IRX, which is much more reflective of what the Fed funds rate is, which is now pushing, again, 1.695%, reflecting, again, the Fed continuing to raise rates here. But we get out 2-year, 5-year, 10-year, 30-year. Again, we're talking about inverted yield curve, which is deflationary. And so we have this juxtaposition here of a declining economic activity. And, again, the Fed's trying to tighten. At the same time, we have major supply problems, which are keeping prices high. As we look at oil, the news today, again, we're down a little bit. Again, oil just tested 125. As we look at the product depth and we get a sense of the term structure, look at the red line here. We're still downward sloping. We're in backwardation. We're pricing in the potential of a shortage. And our supply situation, what we've seen builds over the last couple of weeks, has not really changed materially. And so the only thing we're going to see in terms of trying to cool off prices of goods, in particular food and energy, is what? We either got to stop eating or stop driving, because we're not seeing production pick up. And it's not really, doesn't seem like there's a real desire to see it happen as well. And so oil prices are up here about 116. Again, do we start to see recessionary pressures drive oil down? Maybe. But that's probably not the odds-on bet, as right now we're seeing backwardation. Now, as this continues to flatten, maybe we start to see that price in. As we start to see this hook, and we start to see this front month drop below the back, okay, maybe we're starting to see that price in. But as of right now, we're squarely in backwardation, which implies a shortage. And so as you look at names that are struggling right now, there's a big sell-off in natural gas because the LNG plant that had a fire, it's not going to come online till the end of 2022, maybe start of 2023. But you look at stocks like FANG today. We're pulling back. We're at an area of support. We're not showing strength. It's not, again, this is not when you're really expecting to see a lot of short covering in this area, especially if the economic outlook is diminishing. But if we start to gain some traction, maybe above today's high in the coming days, we may see a retest of the prior high. And that's in essence, you're seeing some reflection of that expectation here, as we have some deep in the money calls being bought at 127.65. Now, I believe those are being rolled from the June expiration here at the same price. So again, we're seeing it kind of rolling out, profit taking, but still keeping it in the money and still maintaining that bullish outlook in FANG. So again, look for this maybe if we shore up retesting prior highs. If we look at Tellurian, this is one that typically generally does have higher short interest, up 6% today at support. You saw a 24 June. So we're talking really short dated stuff, mostly buying at the out of the money option at $4. Again, looking for a little bit of a bounce here, maybe towards 429. Maybe if oil picks up, we see a bigger push towards $5. We do have to be careful of the negative pressures of natural gas and its carryover effect to others in the energy space. Oxy's one that has been on my list for a while over here with higher short interest. Again, it's down today too. So again, energy is not exactly lighting a fire here, but is something to look at when you see the convergence of unusual option activity. You see short interest and bullish price movement, which we've yet to see. XLF, is there any way forward for financial stocks? As we go back to the spider sectors here, XLF is up 1%. The S&P is up 1.2 rather. Only expect financial companies to probably equal perform or likely underperform the S&P. Maybe we crawl back to 3250. There's such a weight right now in terms of the consumer and the potential default cycle starting to pick up again, which I'm not sure really people are really accounting for at the moment. Although this last week, as I looked at, again, we looked at Discover Financial Services, Capital One Financial. You could look at Synchrony Financial. There's been a lot of bearish option activity in a lot of these names over the last couple of weeks. You're seeing maybe that start to rear its ugly head over the last several days, or last week rather, in a lot of these names. But expect to see on a rally, look for X levels to get sold, because is there a pathway for the yield curve to steepen as the Fed is raising rates? Absolutely not. There's nothing here for financials that is right now is really positive, other than they might get a little bit of lift with the market. But again, you can look at and focus on cyclicals, technology companies that might be, that have higher short interest, that may have a chance of producing a little bit of a bullish movement here in the near term, as maybe we make back a little bit of what we lost towards maybe 135, maybe even a retest if things get crazy. Ultimately, what you've got to remember with regards to the market is there's a limitation in terms of how much we're going to move here. And right now we're seeing it fade as the market's still trading. It's before the close. There's limitations at how far this move can get. Maybe we get back to the prior high. Maybe we stall shy of it. Maybe we even just start to fail at today's high and see it roll over tomorrow. The downside scenario will play out. It's only a matter of how much can the market really react, how much short covering can we see in the coming days before we just set up again for a bearish reaction. And again, a good setup would be if the VIX comes back towards the 25 area. That might help kind of reset things to the downside. A stock that has a lot of bearish short interest, right? A lot of short interest is American Airlines. It's up 2.8% today at a support level from March. There was a 24 June 15 call options being bought. So maybe some near-term potential at 15. But again, that doesn't even get you back to the prior high here. It would only be a way station on the way to continue the downward trend in the S&P. GDX, is there a good pathway for gold to surge higher? Absolutely not, with what the Fed is doing in raising rates, right? Decreasing the money supply. But if the perception is the Fed is getting a little more dovish, which I'm not sure you could take that away from Powell's statement today and the FOMC policy statement. But again, we're getting a near-term bounce. Maybe a little bit of dollar weakness may push gold to about 175. But it doesn't stop the optimists out there in GDX at support again. This move will probably underperform gold unless we start to see a big move in the market. But you had a September out here, 32.38 being bought. Again, expecting buying the 32, selling the 38 in a call spread. Again, expecting some big movement to 38, maybe even rolling down as I see this interest here, rolling down to those strikes. But the point is, 38 is pie in the sky. But again, it doesn't mean we can't a little bit of short-term bounce. We'd probably prefer gold, GLD, for example, over gold stocks. But again, if we do see a big rally in the market, you'll probably see gold stocks outperform gold. But the more natural, if there is a short covering rally, again, it's going to be cyclicals and technology. And maybe you get some participation from the bigger names like your Apples of the world and your Amazons, as they probably mirror, again, driving, they're going to be the drivers for the S&P in the near term, maybe even a Microsoft in this case as well. Sorry, the chart's not loading here. Microsoft as well, although we did test a newer lower low there. Finally, NOI, this is one we've been hitting a lot. Bearish activity last week, last Wednesday on PMT. It fell out of bed. All these companies invest in mortgage bonds. NLY is down a lot. AGNC. Again, these are products that buy mortgage-backed securities, MBS. And you look at the Fed right now, reducing the size of its balance sheet, raising rates. The higher rate structure is going to cause existing mortgage bonds to diminish in price as they're paying a lower yield, more than likely. So it makes sense these companies are falling out of bed here. But today, even people taking further downside in NLY, taking these oversold conditions and saying, I think it's going to get worse. Now, again, you might look for a little rally here before it rips lower. I can see me writing here. But the June 550, 16,000 contracts mostly bought. Again, anticipating further downside here. We may not come up for air. One way you can speculate on these oversold conditions is if you got the skew going for you, you could buy an out of the money spread here. So you could buy literally a 5 and 4 for July, right? and maybe just buy the 5. It's not worth. Let me come to the money here, but a 5 and 4 in here. Sorry, a 6 and 5, and that might cost you 40 cents on dollar spread. That's not great. But you can come here maybe and just buy a 5 put. Maybe you get a little something out of the 4, but there's not really much there. But you see how cheap these options are. Granted, they're out of the money, right? $5, that really doesn't work. But higher price, you can look at a higher price option, maybe even some spreads here, or even, again, just focusing on IYR driving the broader, broader market lower. Trying to think if I want to throw on my HYG. So again, right now we're seeing HYG move higher as risk spreads are coming in because we had a major sell-off in junk bonds. Again, look for this to maybe stall out towards 76 in HYG. And that's where a lot of the activity was today. Now, if we start to take out 36, we may have an ability to push towards maybe the midpoint or 78, maybe 80. But that's probably among the more optimistic scenarios. And that'd probably require a more significant market rally. But look for this to maybe test 76, which is we're close to here. And that could create another bearish setup in the coming days for HYG. All right, folks, we've got to run to at the close. It's been a pleasure being with you today. Hope you have a great one. Thank you.